We have an ambitious agenda today. You're going to get a taste of incredible insights as we solve all your problems in terms of thinking about the future of the capital markets technology and the path to 2030. So I'm going to lay out what our agenda is and introduce our speakers. So we'll just move on to the introductions. So it's an honor and privilege to be here today with two luminaries from capital markets trading technology. We have John Lowrey, who just left Citi as the global head of electronic markets. And John has incredible experience, 48 years at the forefront of market innovation in automating trading, making it more electronic, more efficient. He has led that from an algorithmic perspective, electronic trading and high-speed trading businesses. At Lehman, he did that. He was a CEO and founder of Kayaks and a number of other exchanges, as well as the founder of a messaging infrastructure and data company. So well positioned to discuss this. Similarly, we have Robert Cooke. Robert Cooke is a CTO and founder of ThreeForge. ThreeForge has a platform, AMI, which is a low-code platform sitting inside some of the largest investment banks and broker-dealers, monitoring and managing over 10% of global equity flow daily. Before founding ThreeForge, Robert served in senior positions at the likes of JP Morgan, Bear Stearns, and at the dark pool venue Liquidnet. And I'm your moderator today. I'm Brad Bailey, a research director in the capital markets at Celent. I come from 25 years in trading technology, trading, and strategy. I cover innovations in the front office for Celent, and happy to be here. So before we get started, I'm just going to kind of lay out the day on the next slide. We're going to get started. John is going to talk through his ideas on the incredible changes that are taking place in the business and technology in the capital markets today. You know, we're really going to see some amazing insights that'll resonate with senior management across technology, across the businesses, delving into the business and trading trends, the fundamental shifts in what we're seeing in data leverage and delivery, the evolution of algorithmic trading around the wheel allocation and how that has profoundly shifted what is happening. And then we're going to go into a roundtable where Robert Cooke, the ThreeForge CTO, John Lowrey, and myself are going to discuss some of the insights and some of the trends that we're seeing. Because we do know, we see everyone in this business, everyone on this webinar sees that we're at an inflection. We've seen the competitive pressures, the fast and rapid changes in the business needs, and how the right technology, the right structure to develop applications needs to underpin that. And I do want to mention that following that, the Q&A, following our roundtable, we'll have a Q&A. So please start sending in your questions. We'll try to get to them. If we can't, ThreeForge will follow up with you. I do want to then add at the end, there'll be a link to a Celent report, as well as instructions how to get the deck from today. And just real quickly, Celent wrote a report on looking at this. What are the emerging trends that we're seeing? The way people engage with their clients, the speed of business, the rebuilding of the wheel over and over on the application side, yet inflexibility sometimes on how the clients and their needs. And you know, we see in a way the continued rise in costs, at least on the trading side for trading capital market firms, of the percentage of IT costs relative to revenue. And it's becoming unsustainable. So what are the pressures and opportunities for the buy and sell side today as they rethink the next decade, preparing for 2030 for what they could do today and what they will be doing as we move into the centricity of data and new models for engagement? So without further ado, I'm going to turn it over to John, who will start his presentation.
Hey, Brad, thank you very much. Appreciate everybody, and happy to be here and talk to everyone. Hopefully everybody can hear me okay. Open with a quote from Barry O'Reilly. Barry is a really forward thinker, leading thinker, and quite a evocative person who talks about the implications of the data-centric world. He's written extensively about what data means for organizations. And this quote, I actually picked it out prior to finding out that a piece of NFT, or a non-fungible token, traded for $69 million, a piece of artwork, which was just announced today. So maybe this statement will be challenged. But fundamentally, where are we? We are now at a place where the cost of managing massive amounts of data at scale has been greatly lowered. Data management and data analysis has really largely been successfully automated. The impact of machine learning and AI processes on data insights have emerged and are working at speed. So we really truly do today now have in our possession the tools to make data much more meaningful and use it in a different way. Next page, Brad, please. So what we're seeing is a perfect storm that is managing is in effect both the buy and the sell side. And I've listed a number of areas where there are huge challenges to the business model that we can see. You can read through this. If it's small, just pinch down your screen. But I think it's important to note that both the global brokerage and asset management industries are facing very simultaneous headwinds, and a lot of the elements of those headwinds are the same. One clear fact: neither businesses are growing or have been growing at the pace they did during the 80s, 90s, and the aughts. Both the buy and sell side in terms of business models are facing pricing and margin pressures. Both suffer from massive overcapacity, and both suffer from unique challenges to their core cash businesses. So these headwinds are driving wholesale changes in the operating models. And we're going to find that as we look at this and exploit more, both brokers and asset managers need to get smarter, more analytic, and do more analysis at scale. And really, analytic capabilities are going to be the drivers for change going forward. I've labeled this slide as a key existential moment because I think these businesses are really, really being challenged. And I want to go a little bit more into depth into some of these points before I move on the presentation. For the brokerage industry, we have both high personnel and capital costs. That is a bad place to be. The traditional sources of revenues are really not present. IPOs, research payments, et cetera, have basically been banned or greatly changed the economics of the industry. The growth of SPACs and ETFs pay very little to brokerage firms. So we need to be in a position where we can scale, and we must be able to scale through technology. MDs in the industry are becoming dinosaurs, and there's a real assertion to be able to push down the scale of the organizations and flatten out stuff and do much more with more junior staff. But in order to do that, you need to get data and information to that staff. They don't carry it around in their brain, they need it. So most organizations, unfortunately, have done very little to automate and support much smaller sales teams. And it's going to take really robust, deep data management to be able to provide that kind of scale. So the fundamental question for the sell side: can cash be remade to be profitable and continue to be the foundation for all brokerage products? The buy side is on a very similar journey. We've had explosive growth of assets over the last decade, but it's been centered in two key areas: passive investing and ETFs. The fees generated from these activities are much lower than traditional asset management. And active discretionary management, which was the hallmark of management in the 80s, 90s, and the aughts, has mostly resulted in very poor performance, with very, very few active managers beating indices themselves. And then we have this growth in quantamental investing styles, in robo, maybe NFTs, tokenization of risk, et cetera. And what this will mean as these styles grow is there's going to be a massive investment in data and data management and infrastructure to be able to support these new types of activities. So as we go back and ask the questions, asset managers really, this is their existential question. Am I an investor? Do I buy stocks, or am I a structure? Do I structure portfolios and investments, tokens, et cetera, whatever these things are? Doing both is extremely expensive, and managers are being forced into make decisions that they're really unprepared to make at this point. Next page, please, key trends. So using that as a guide, there are many, many trends we could talk about, but I really just want to focus on 4 key trends here to support kind of the vision that we're going to be talking about here. First place, for financial services in particular, the future infrastructure will sit in either colocation and cloud. So what does that mean? Large data centers and server farms will be obsolete that are owned by brokerage firms, and the cloud-based services must operate in a much latency optimized environment, which they do not today. So you think about one fundamental problem. Most of the cloud is based in Virginia, and most of the data centers are based around the marketplaces in New Jersey. We have yet to see those marrying each other. Might they marry in Texas? Might an exchange move to Virginia? Or might a cloud company really build a major data hub in New Jersey? We're going to find out. But right now, there's an awkwardness and a latency in those processes that are still a hindrance to bring that together. Secondly, competition is going to move from very differentiated technology to quite advanced data management. And that's really what we're talking about here today. So there's a number of reasons why this is happening. We're going to go through some use cases, or one use case that will show this. The second thing is the cost of technology is just so high. And if you look at the technical debt of our enterprises, especially the technical debt that sits in the cash business, which is the cash cow of the industry, at least on the brokerage side, and the debt of producing active management, there is a huge strain on these organizations to be able to pay down this debt and be able to move to new code and new environments. Number 3, these movements toward low code frameworks, open source, microservices from a technology side are here to stay. These are very, very critical changes which will help firms be able to pay down the debt and be able to lower the cost of managing their infrastructure. But what will be the competitive drive? That's the cost-saving drive. What's the competitive drive? The competitive drive is going to be around data analytics and data management, because new content is going to be the next key area and the area for differentiation. With this, we're going to have new roles come out. So right now, if you look at brokerage houses, investment banks, they have very, very few data scientists. Many quants, but very few data scientists. That is also true for the buy side itself. So that money that is now spent on application and coding is going to have to wane as a competitive threat, and that good application coding should just be set in configs themselves and to be able to reposition people within the industry. So what does this lead to? This leads to a world where data and analytics is the new battleground. This is, I think, a key point. So let's talk about the rise of the wheel as an example of this, a real world example that's going on today. Commissions are expanding at a record pace for commissions that come over the wheel. What is the wheel? The wheel is a buy-side algorithm that chooses execution partners for specific transaction-based on certain quantitatively measured criteria. Apologies, I didn't say that very well. You can read it. So what are the drivers for this change? I've listed 3 of them, and I think we need to look at what these drivers are. So one is cost efficiency. First place, the buy side themselves, as we said, is having the same sets of problems. how do they automate, and how do they deal with the labor force they do, and how do they be able to trade and transact in an automated way and control that. The wheel is one of the key answers to that in terms of allowing for buy-side automation, allowing for order flow to go to brokers chosen on quantitative factors, and also send order flow to specialty desks or other places to be managed by humans, so that the vast majority of flow can just go through this. What this means is the buy side is not touching orders anymore. The second point is really the regulatory corollaries that have gone with this. This started in the early 2000s with unbundling in the UK and has just moved through. And that is that execution needs to stand on itself. For brokers to earn an order, they have to have high quality executions. Those are mostly quantitative measures of execution. A wheel measures execution quantitatively, and we've had this massive growth in the TCA industry. The third is really the STP and asset management, obviously related to cost efficiency, but it's really something I don't think the sell side understands very well. And that is the buy side is really now a factory. And if you look at the problem we posed a couple slides ago around, are you in the business of investing or structuring? It's not so simple, because in many cases, the answer to portfolio answers a structured product or a swap, and that has to be understood, who the counterparties are, where can those orders go. And so a lot of decision-making prior to sending stuff off to brokers is happening on the buy side. Portfolio construction, risks you're taking, whether it's a use of a structured product, whatever those types of things are. And that is all about automating that factory, that production of that asset itself and the portfolio itself. So what this drives us to is that clients and brokers are going to have an analytical relationship. That is a key part of what we are looking at. Fix is a perfect medium for this, but it must mean that we have bilateral analytic capabilities to be able to drive this kind of relationship. Next slide, please. Thank you. So you can squeeze down, look through this. I'm not going to go through everything here. But really, the data revolution, as we said, is not new. And we've been methodically working through the problems of infrastructure, database management, real-time management, structured and unstructured data. And that's not only gone on for financial services, going on all through the internet and social media and other data-driven businesses. As Gary O'Reilly notes, we are at the time now we can make meaningful use of data in itself. And so what does this mean for the future? A couple points I want to make here. I think there's 5 points, in fact. For financial services, we're going to see heavy commoditization of the application development itself. There's going to be just less code writing, period. And I think Robert Cooke's going to talk about that, but that's an important thing. Secondly is that we need to have real-time analytics structured, using structured and unstructured data, feeding into trading risk and decision-making applications real-time. That has to be happening now, which means those applications, the data that sits in the cloud, and what we have in Colo have to talk to each other in a real-time sort of way. All this leads to the fact that data will become an explicit asset and must be treated as an asset. I always find it very, very interesting that data itself is not a balance sheet item. The data that you hold is not considered to be an asset. And given it's the lifeblood of the organization, certainly the lifeblood of the organization in the future, I find that very interesting. So it means the world is more interconnected, a web of data agents and analytics and decisions. And I think the corollary to what we're talking about in terms of coding is that code itself moves from an asset, it drives your platforms to a liability. It's expensive to manage, keep, update, test. In a world where we continuously rewrite, that must come to an end and is really becoming a problem for the industry. One more slide, please. And then, Brad, I'm going to turn it over to you. Some of the concepts on this I've taken from work that Barry O'Reilly's done. If you look at it, the left-hand side, we're talking about today, and I'm going to talk about what organizations become like on the right-hand side of this. The tagline here really is very straightforward. Well-structured data capabilities will power more successful products. Data are not derivatives of products, but data drives successful products. The management of data does that. So today we have a very application-based technology footprint. We plan, we have hierarchical stuff, we write BRDs, we have all sorts of things that are based on coding and management of coding and running coding. All of our metrics, our deliveries, everything is based on that set of relationships. And we create products through applications. In the new world, the new paradigm, we're in this middle period of digitization where we're starting to see that start to come apart. But in the future, we're going to see organizations be data dominant, where data leads. Applications don't lead, data leads. So instead of managing around plans, we manage around simulations and models. We simulate things, we simulate environments, we look at answers, we run prognoses, and we re-simulate and we redo things. The drivers around decisions are going to be data dominant. What data do we need in order to perform the task, in order to do the job that we want to be able to do? And how is it done? How is it tagged? Where does it sit? How do we manage that? The metrics that we're going to see success on are going to be much more around the insights we glean and the probabilities that come out of the work that we do. And the value that we create are going to be data-driven models, data-driven business models. We know that some companies like Amazon and Google are much further down the path as data-heavy, data-thinking organizations than brokerage firms are, but we are going to have to pivot our businesses into this kind of paradigm. That's my view of the future. Brad, back to you.
Thank you so much, John. So as we move on to the roundtable section, John, you covered a lot. I want to reiterate, please send in your questions. But at the moment, like Robert, John went through a lot, a history, the changes, profound. What are your thoughts on the presentation?
Yeah, well, I think it's a great presentation, and I think we're fortunate to be able to get these sorts of insights, and I'm glad that he was able to do that today. You know, as part of Three Forge, we're always looking to get these sort of insights from business leaders. This helps us shape what our product's going to look like, what our roadmap is. What gets me excited is, you know, our job is to basically take these high-level, big, grand, decade-long sort of trend ideas and then codify that into ones and zeros and build applications around that. You know, some examples are, you know, John is talking about how, you know, the cloud, ultimately we have this latency issue, but that's going to be resolved. It's been a hindrance in the past. We're starting to see things move into the cloud. We've been anticipating this at Three Forge for a while, so we've been thinking about how does that work? How are we going to basically address those things? Same thing with microservices. How are we going to integrate with microservices, so on and so forth? And low code is going to be a big part of it. I mean, that's kind of the central thing for our product. But, you know, the way I look at it, kind of taking a little bit more of an IT perspective, my background was always on the IT side, is that I feel like the last several years or maybe more, it's been a bit of an identity crisis within the fintech industry, meaning that, you know, the question is, if you're a tier one bank, are you a finance company or are you a technology company? And needless to say, as a finance company, you need technology. How could you obviously compete without that? But I don't think that necessarily means that you must build all technology yourself. An analogy I would make is, you know, airlines don't need to build their own airplanes. They get to come up with different ways to be creative and brand and market it, but they don't necessarily need to be in the business of building airplanes. And frankly, if JetBlue decided to build their JetBlue liner, you know, I think the costs would go way up. So I think it makes sense to really look at it along those ways. And I think what we're starting to see happen is that financial firms are becoming more of curators of technology, and we're seeing it as these labs start to spring up. And what I mean by that is that instead of building all technology from scratch, and John talked about this quite a bit, which is, when you build all this stuff from scratch, you had a lot of legacy code that you have to maintain, and it's just a lot of overhead, and obviously it can be buggier and this and that. So what we're seeing instead is that firms are now becoming curators of technology. Basically, they're going out, looking at all the different vendors, deciding what vendors make the most sense for different applications, and then leveraging those, similar to airlines choosing the best airplane for their particular needs. Are you a long haul carrier, short haul, yeah, so on and so forth. And I think that's a good thing, because what it means is that we're moving to a more efficient model where different institutions can basically be sharing the same sort of solution through this vendor platform concept.
Yeah, absolutely. Look, John, I mean, you brought up, like, just tying into what Robert just said, and you think about the cost structure and the legacy, like, how do we get from 2021 to 2030? Like, how do we lower IT in the light of the complexity of the legacy systems? John, what are your thoughts?
Well, I think first there's an inflection point. I'll restate the fact. Technical debt is large for every institution. What does that mean? It means that there is a lot of unused, unamortizable value in the present day technology that they have. In a classic firm, this would be written off. At banks and brokers, it's not written off, it's just amortized out into the future. So that's the financial place that these banks and brokers are. So what is the price at which we convert? And I would estimate that that's somewhere in the 50 to 75% of total cost of ownership. Meaning, if your choice is you can fundamentally build it for nearly the same price to move it out, that is not going to do that. But at 50% of that total cost of ownership, your current total cost of ownership, or your future projected, you probably would look at moving that out. And we are seeing this period now where the total cost of ownership for vended systems is being lowered and lowered and lowered because of the things we're talking about: low code, use of cloud, et cetera. So I think that organizations should be now, but in the next few years are going to have to be prepared for this kind of step change, because the cost of doing business in the way that we're doing it today are not providing economically viable returns. If you look at the returns for banks and investment banks, they're very, very poor relative to other industries, and this is not sustainable.
And Robert, what is your perspective? I mean, you're building solutions, you're looking forward to the future. How do you see it? What is your take on that?
Right. Well, to throw some numbers out there, I mean, again, to John's point, there's a cost or a percent saving where it makes sense, and perhaps 50% is that number. I think the total cost of ownership can get dramatically lower than that, but this is still in the early stages. So we might be looking at 50% right now, but I think those numbers are going to come down and down. But something has to happen, because the way, if you just broadly speaking, you look maybe 20 years ago, IT spend was, let's say, 15, 20% of your total cost. Now we're looking closer to 40 to 50%. Obviously, if this trend continues, we can't get to 100%. We can't get to 110%. So something's got to happen, and we've got to find these efficiencies. As a vendor, we're interacting with a lot of different firms. We're getting a lay of the land. I think what's happening right now is we're seeing cases where, yes, we are deployed and we're seeing a total cost of ownership decrease. Some cases it's greenfield, where we're building something new on the platform. In other cases, it's replacing a system. That's very tangible, where you can see the savings. Simple example would be, maybe you've got an existing platform, 100,000, 200,000 lines of code to build something like that. You rebuild it on a low code platform, you might be able to reduce that down to 10,000 lines of code or less. Now, just simply put, if you're maintaining 100,000 lines of code or 10,000 lines of code, there's obviously a lot more technical debt, as John put it. And I think that's something that we just have to all acknowledge, that having these huge piles of code is no longer an asset. It's actually technical debt. You want smaller sections of code. You want high impact code that solves the problem you need. And I think, so I think absolutely, you know, the savings are there, and I think it's going to get more dramatic over time as people learn. And I think right now, you know, our clients are some of the most, I would say, the most forward-thinking companies out there. And I think that there's a lot of people that are kind of waiting to see how this plays out, and then they're going to make the dive. I think there's going to be a hockey stick moment where suddenly everyone's going to be jumping into this.
Robert, let me just follow that up. I mean, what does it take to build a low-code platform? Like you framed it a little bit. How do you see that?
Right. Well, a lot of caffeine, just to start with. No, but no, I would. You know, the way I look at it is I try to break code, not to get too technical here, but I just break the code into two buckets. It's either something that gets written once and used many, many times. It's repeated, it's a reusable module. And in that case, I look at it, that is something that should live inside a low code platform. And really the goal there is you want to make it as efficient, secure, as fast as possible. Our mantra is if it takes 10 times longer to code it so that it'll be 5% more efficient, that makes perfect sense. Why wouldn't you do that? Everything has to be scalable. Everything has to be, you know, these sort of factors that maybe you don't need to think about if you're doing a one-off sort of solution. Now, on the flip side, you also have code that is very business-centric, solving a very particular business need. Now, that's something that I feel like should become intellectual property of the customer, of the firm. They basically own that code. You know, how to debit from this account and whatever it happens to be. That sort of stuff lives outside the low-code platform and basically is owned by the clients. And so I think it comes down to really deciding where the boundaries are, similar to where the boundaries of an operating system, something along those lines.
Interesting. Just to switch gears, because John made a lot of questions coming around this, but this idea of data on the balance sheet, the move to data, what is that? What are the implications from an IT perspective? Like, what are the changes as data becomes an asset and that becomes more central to the business model and the revenues of the capital markets? John?
Well, right now we have data teams and dev teams very separated. They're different things, they're different places in the organization. Generally, applications produce data, they throw it onto a bus and they never see it again. That has to become reunified in some way. And that the application owners, i.e. the people that are working on the workflow and working on how to process and make use of data, need to understand what that data is. Second thing is the business people themselves need to take ownership of the data and understand what they're trying to drive out of this. Now, I think in the case of building algorithms in the smart order router, that happens. There's a real integration of business thinking and data management within those sorts of things because it's so finely tuned. And again, that's a perfect example of the way everything else is going to have to get married. The kind of precision that we see in app and management, we don't see in other aspects of what we're talking about. And so I just think the teams have to be reoriented. They're going to be much more fluid, and the skill sets are going to have to be married together in different ways. So what it means is that people are going to be able to choose potentially technologies, vendors, solutions, low code, this, that, take these things, take from libraries, do that, in order to enhance and use the data that they want to be able to do that's unique to them to be able to provide the answers that they want. It is going to mean a mind shift, though, in terms of how organizations are set up today.
Robert, just real quickly, how do you see that thinking about that move to the data and just, what are the IT implications there?
Mhm. Well, I think a few things. Like John said, I think we're going to see a bit of a shift in terms of the skill sets, and I think there's still a long way to go in data science. And I think that the sort of complexity that you can apply to this and draw real insights out of data is astounding. There's kind of the trivial sort of just doing aggregations and things like that, but as you get into it, there's just such a wealth of information sitting behind there. I think from a technical perspective, one of the things that I think we're seeing more and more, and we've been anticipating this for a while, and so we built the platform around this, is that you have different types of data, and the whole goal to really get insights is to bring this together. And so John mentioned a bunch of different types in his presentation. I'll just give a very simple example. Like you have market data that's sitting in a column or database that's stored a very specific way, and then you have emails. Let's say emails that's unstructured data. You'd store that in a very different type of database. Maybe you have security footage or something like that in a very different type of database. Now the question is, how can you bring these different sets of data together and make something cohesive out of that? How can you bring insights out of that? Again, you've got very, very different types of data stored in different types of databases, and how do you bring that together? And that's where data lakes, traditional data lakes, while useful in some cases, fall a little flat in that. And so I think we're going to see more advancements in terms of how these kind of virtual layers for letting you access across the organization and reach into your data like that.
Yes, I think we'll switch to the Q&A part of the webinar. So one first question we got was, I think for John, you mentioned that the data we have is not an asset on the balance sheet. Should it be, and how do you quantify the data? How do you think it should be monetized as well?
Yeah, so that's a really, really good question. Thank you very much, whoever sent that over. Data will emerge as an asset on the balance sheet as the data itself is understood to greater extent of what it can do in terms of driving platforms and driving revenues and become a corpus in that. So we already see some sorts of data. One type of data might be IP itself that is valued on a balance sheet. But data itself, we have not seen that happen. That being said, data is taken in the private equity world and understood as part of the value of a company. So you look at companies, they count eyeballs, they count impressions, they would count all kinds of other things that are really data-derived things in order to create valuations and do that. If you went back and looked and read some of the documents, the S10 documents, et cetera, for some of the IPOs for Uber, et cetera, you can see some really interesting discussions around data, which they use in order to imply valuation. But again, it's not carried on the balance sheet as such. It's carried as a type of goodwill. So I don't know how that's going to play out. I just think it's going to be an interesting thing that something's going to have to happen in this space as we become much more data centric, and data becomes the place by which is the glue to organizations.
There's a good question here. Is there an inbuilt resistance towards new technology from IT wanting to keep its pace and budget? I think
I'll answer from a business point of view. I'll answer from a business point of view. If a vendor would say that the competitor always is internal IT, and for business people, it is always this kind of friction between what can and should we build in house, and what can we do outside. And to me, the answer was always kind of perplexing, because of course we can build anything we want, but should we? And really having that organizational courage to deal with the should. Why are we building commoditized processes? Why are we building things that really add no value to what we're about in terms of IP, et cetera, and how we're going to be able to do that? And that's a very difficult thing for organizations to get their hands around. I think by and large, some firms do it better than other firms. But by and large, I think we're at a point now where I would guess for major banks, brokerage firms, about 80% of technology is in-house built, 20% is vended. I'm guessing at that number. And I think we're going to look to a world where that number is completely flipped. The 20% is IP and valuable, and the rest should be built on frameworks, low code, and other sorts of smart application management, which allows then the rest of the organization to focus on more critical things. Robert, I don't know if that makes sense to you.
It makes perfect sense, and it's a difficult question to answer politely, but it's yeah. I mean, it is an interesting challenge, and you know, it's everyone's acting rationally, and you know, it really comes down to where I think during the when the vendor is going through the process, where are they? Where is the customer already in that process? For example, is it a greenfield? Are we replacing something? Is it something that's having performance issues and can maybe be better? Is it something with massive cost overruns, et cetera, et cetera? But I think you know, generally the organizations at large, the architecture and IT offices are recognizing this, and so they're setting up. Again, I mentioned in the beginning, they're basically setting up these labs that do the independent testing, almost like the consumer reports of an organization. So it's an unbiased group of people. They can go in and they have a process. And I go back to that is, I think, a good way for them to identify how IT operates, which is you have a problem set. The first thing is you go to the lab and you say, listen, are there any solutions out there? Is there anything you're aware of? Or we think there's a vendor that might work. And these are experts that know how to look at vendor products, spin up systems, do those sorts of things, and then give their results back to the team that specializes in that particular problem. But I mean, it's a great question, and it's one that I think, especially as the next generation of developers come in, I think we're seeing a little bit more of an open mind towards trying new things. So, you know, it's just time. But at the end of the day, it's a vastly more efficient solution. Like John said, 80% I believe should be vendor-based, 20% should be custom. That sounds about right to me as well. And it's just a matter of time before that's how it plays out. And so, you know, that's how I see this going.
What about, like, you know, as you extrapolate out these trends, like who are the biggest winners and how does it change hiring? What are the implications for hiring? I'll put that out there.
So I think that if you look at a traditional trading floor, there are going to be very big changes going forward. I see a trading floor where there's a lot less salespeople and a lot more people that are desk coders that operate from Jupyter notebooks, work in Python, and solve problems, and in a way that this is all completely wedded into the technology and security of the organization itself. These are data scientists, they're quants of sorts, that we get a much more analytical focus to the workforce and how things are done. But we're not just talking about looking at market data and numbers. We're talking about social media. We're talking about all kinds of things that need thinking through, structuring, et cetera, and understanding. We had a perfect example of this with the Reddit stuff in GME and what went on there. And if one was aware of what was going on in the social media space and had a view towards it, you probably had a much better idea of what was happening than, oh, wow, what's going on over there. we're going to see more and more of this. We're going to see more and more of this melding of sorts and types of data. And market data is just going to be one of the inputs, not the dominant input, an important input, but not the only input. And we are going to need people that can be able to spin up and analyze and look and think about that data. And that can't be done on overnight changes or a month later in technology programs. It's got to be done on the desk. So skill sets are going to change. Type of people sitting on the desks are going to change. And that means that other skill sets need to be de-emphasized.
Yeah, absolutely. I think that, what about, like, there's a couple questions around the theme of, advice on information security concerns as you think about engineering security first postures into the code and processes. Robert, do you want to take that?
Sure. So I think in terms of security, one of the biggest issues around building these internal systems is, how do you manage that security? It's very hard to build a system with 250, with 250,000 lines of code, go through and make sure everything's secure and built according to current standards. And so what ends up happening is you just put these large sort of guards around the whole thing and just assume that everything internally isn't secure, and then kind of just try to secure around the periphery. But once you start to think about things from a vendor perspective, we're basically building a generic layer that people build on top of. So embedded in that layer where everything is traveling through it, security just gets built in as a paradigm, because we don't know whether the application is going to be used externally or internally. And I guess maybe I skipped this part, but I think a lot of times people think, oh, well, this is an internal application. It's used for internal groups or this and that. So security isn't as important as if it were going outside the organization. But I think the way to look at it is always assume the worst case. Always assume that people are trying to compromise your system, whether it's internal or external. And so I think that, over time, as security gets more and more important, and I think right now we're really starting to see this with some of the recent breaches, I think the focus on having less code to sweep through and maintain, and being able to do so. Another way to look at this, we go into an organization, we solve 15 use cases. They do one pen test against our software, and then basically now all they really have to do is check that small code base for each one of these use cases. If those were all built independently, you'd be doing tons and tons of pen tests on these massive installs on lots of different platforms. So I think from a security perspective, this maintaining millions and millions of lines of code is going to be really hurts the bottom line.
Absolutely. Well, we're getting low on time, but there are great questions, and we're going to try to follow up after this. Just want to remind you, you can download the report, and you can email 3Forge for John's deck. But this is really interesting. John brought up this point, and there's a question. If exchanges were moved to different states closer to the large cloud providers located in Virginia, closing the data latency gap, how would this impact application development? Actually, if John, you thought of that, or Robert?
Yeah, I think that's a really interesting question. Thank you. So one of the key things is the development of technology that can converse in colo and cloud simultaneously and manage that conversation. So things like Kubernetes and Docker and other sorts of things. Robert would know a lot more about these technologies than I would. But I think we're going to see a new paradigm come into that kind of technology that drives where these processes sit and how we do and how we enrich the data themselves. So we experimented when I was at Citi a lot with Kubernetes. There are other choices, I believe, and I'm not here to talk about one versus the other, and certainly not here to talk about what Citi did, but just to give people an idea. Robert, do you have any thoughts on that? It's really an interesting question.
It is. Well, I think generally, when it comes down to the cloud versus colos in like NY4, uh, what happens is all of a sudden the cost dimensions kind of flip. Right now, if you're sitting in NY4, your focus is on how can we get as powerful a piece of hardware as we can that's as small, takes up as little rack space as possible, et cetera, et cetera. So horizontal scaling isn't as quite a big of a deal. Now, once you move to the cloud, all of a sudden everything has to be able to horizontally scale. So I think that software is going to have to be a lot more focused on how can you spin up new instances, how can you elastically expand as volumes increase, so on and so forth. So I see as the cloud grows, I think that it's going to have a big implication, and a lot of these systems aren't prepared to run in the cloud. Also, going back to the security standpoint, once you're running in the cloud, security needs to be paid more attention to at the fundamental level, because you're no longer in this nice little protected environment, or at least not as much. You can do things around that a little bit. And then finally, I would say, from an accessibility standpoint, from users being able to access systems, it's very different from having a piece of technology physically sitting on your desktop versus something that's going to be running into the cloud and you're going to be accessing remotely. All of these sort of things are what we're paying attention to.
Absolutely. Given there are so many great questions come in, we do have apparently a few more minutes. There's been a few around, given what we're saying, if you were, what would you recommend to young computer scientists to learn? Like either on a language perspective, or how do you think about that evolving?
Me?
Maybe for
Me?
Robert?
Oh man, you don't want to listen to me. No, I actually, it's funny. I've always thought that math, it really comes down to math. I don't know, it sounds a bit hokey, but I feel like you can learn language and you can learn how to think around state machines and threading and stuff like that. But really, core good math skills. I mean, when I interview people, Cartesian product, how do you do basic math, how do you do calculus, things like that, because the rest you can learn, but that's just my take on it.
Okay, so we are coming up and we're going to wrap. And Robert, what are the key takeaways that you see from this discussion? We've talked in business, technology, data.
Mm-hmm.
What are the key takeaways?
Well, I think one key takeaway for sure is that data is going to become an asset, as John said, or it is an asset. It's going to be recognized and valued for the asset it is. And that's going to, again, go back to getting people that are good at math so that they can evaluate this data and so on and so forth. And I think the second thing is really, I look at the last 10 or 15 or 20 years as this explosion of ideas on how we can build systems and how we can do things. I think the next decade going forward is going to be now taking what we've learned and how do we do it efficiently. So those are the two takeaways. Yeah.
So again, please reach out for the report and information. I'm going to turn it over to Sarah for any.
Thank you, John, Robert, and Brad, for today's conversation.
Thank you.
We will be sharing it on our social media, so be sure to follow us on LinkedIn and Twitter. And thank you again, everyone, for joining the talk today.